Welcome to Breaking News to Trading Moves.
Glad to be here. Today we're looking at, well, the recent churn in the auto sector, specifically how the market's reacting to Q3 results landing right as those federal EV incentives expired.
Right, and that timing created a really, a situation that needs explaining. The main headline grabbing attention, Tesla. They reported record revenue for Q3, but, and this is the kicker, their profit actually saw a sharp decline.
It did. And if you're watching the sector, that seems like a paradox, doesn't it? Record sales, lower profit. It wasn't about volume, though.
So what was it?
It really came down to margins getting hit hard.
Yeah.
Three main things happening at once. First, you had U.S. buyers, scrambling to get that $7,500 EV tax credit before the September 30 deadline.
Okay, the deadline rush. Makes sense.
Second, the company faced higher costs. New import tariffs played a big part there. And third, they seriously ramped up their spending on R&D, especially AI and robotics.
So our goal here is to figure out how this mix of things, strategic bets on the future, short-term demand swings, rising trade costs, how it splits the market. We want to identify the companies, the sectors that might actually benefit, the winners, and those facing, headwinds right now, the losers.
Exactly. Let's start with the financial picture. That record revenue, it tells us people are buying EVs, but the profit drop, that's the margin pressure story. How did costs shoot up so fast they actually outpaced those record sales?
Well, Tesla pointed to two big things on the spending side. First was the sheer cost of trade friction. They specifically mentioned $400 million.
$400 million?
Yeah, $400 million in quarterly tariff costs,
Yeah.
just on imported auto parts. That figure alone, for one quarter, kind of paints a picture of the global manufacturing environment right now.
It really does. $400 million isn't just, an accounting line item. It's a real operational drag, hits the bottom line hard. It shows how fragile some supply chains still are and why there's such a push to regionalize.
And the second cost driver they mentioned is more forward-looking. It's that increased operating spend, the OPEX, going into their AI and robotics plans. They're investing heavily there.
Right. Betting on the future, essentially. Even with margins tight, they're kind of doubling down on autonomy, next-gen manufacturing, using today's revenue to fund tomorrow's tech.
It's that classic dilemma, isn't it? Spend now for long-term dominance, even if it hurts the quarterly numbers.
Precisely. But let's circle back to that incentive cliff. The rush for the $7,500 credit. That definitely created what people call a pull-forward effect.
Explain that pull-forward bit.
It just means Q3 sales were, inflated. They included demand that probably would have shown up naturally in Q4 or maybe even early next year. People bought now to get the credit.
So like borrowing sales for the next quarter.
That's a good way to put it. And the consequences, the market now has to expect a bit of a slowdown, some softness in U.S. EV demand in the near term.
Okay, so investors need to look maybe beyond just the pure EV makers then, to see who's better positioned for this temporary dip.
Exactly. Which brings us nicely to our first group of potential winners. These are companies built more on, let's say, resilience, starting with the Diversified U.S. automakers.
Okay, who are we talking about here?
Companies that don't just rely on EVs, especially not on that specific federal credit. They've got a strong mix, internal combustion engines, ICE vehicles, and importantly, hybrids. Hybrids are getting a second look from consumers right now.
So thinking Ford, ticker F, and General Motors GM.
Those are the key examples, yeah. Their strength is flexibility. Now that the $7,500 credit is gone, the price tag on a lot of EVs suddenly looks much higher. So near term, you might see demand shift back a bit towards more affordable, proven hybrid tech. And that's a market where Ford and GM are really strong, very established.
But hang on, are they winners just because of timing? I mean, yes, their current lineup gives them cover now, but they still need to spend massively to catch up on the EV front long term, right? Is this just a temporary safe harbor?
That's fair. It's a valid point on long-term strategy. Their future does depend on that EV transition, no doubt. But if we're talking about the immediate market reaction right now, reacting to Q3 and the incentive ending, their ability to make good money, good margins from trucks, SUVs, hybrids, that provides stability the pure EV players just don't have.
Okay.
And we saw some evidence, too. During that Q3 period, Ford and GM actually posted stronger year-over-year U.S. sales growth than Tesla did. So they have a floor, a base, that makes them relative winners in this specific context.
All right, point taken. Let's shift gears then. Second category of winners. This one seems tied directly to that second cost driver we mentioned, the big R&D spend. AI compute and servers.
Yeah, this moves us away from the cars themselves and more towards corporate strategy. When Tesla flags a 50% jump in OPEX for AI and R&D, well, that signals something important. They see the spending as absolutely critical regardless of margin pressure. It's like a strategic priority.
And that spending directly benefits the companies supplying the hardware for it, the
Yep.
high-performance computing stuff.
Exactly. We're looking at companies like NVIDIA, ticker NVDA, and supermicrocomputer SMCI.
Okay.
The thinking here is pretty direct. Tesla, and likely others moving in this direction, need powerful chips, those accelerators, and the server infrastructure to run them. For training AI models, for robotics development, that investment is likely to be sustained and it's large scale.
So NVIDIA and Supermicro are like the picks and shovels providers for this AI push in auto.
That's a perfect analogy. They benefit from the corporate capex driving this R&D, not from consumer EV credits.
Okay. Now, moving away from tech hardware, our third winner category comes back to that first cost driver you mentioned, the tariffs, the import friction. We're talking about domestic materials and components.
Right. That $400 million tariff hit for Tesla. That's bad news for them as an importer, but it's potentially good news for domestic competitors.
Hmm.
That kind of financial pain creates a really strong incentive to look closer to home for supplies.
So this helps U.S.-based suppliers of basic industrial materials, like steel, aluminum.
Precisely. Companies like United States Steel Corporation, ticker X, and Alcoa Corporation, ticker AA, come to mind.
How does that work exactly?
Well, if you're an automaker facing unpredictable, steep costs on imported steel or aluminum, suddenly domestic sourcing looks a lot more attractive. It offers more certainty on price, potentially lower logistics costs, and obviously no direct tariff hit. It just strengthens the hand of domestic suppliers, giving them potentially better pricing power and maybe more volume as manufacturers try to de-risk their supply chains.
Makes sense. Shifting sourcing to avoid those costs.
Yeah.
Okay, so we've covered the winners. Now let's flip it. Who's caught in the crossfire here? The losers. And I guess the most obvious group, given the incentive expiring, is the pure-play EV makers.
Yeah, they're definitely the most exposed. These are the brands only selling EVs, so they're incredibly sensitive to any bumps in the market, whether it's rising costs from Paris or more immediately, that $7,500 credit disappearing.
So this includes Tesla, ticker TSLA, obviously, given their profit drop despite record sales, but also others like Rivian Automotive, Rivian, and a Lucid Group, LCID.
Exactly. Look, Tesla has the scale. They can probably weather it better than most, but even their profit took a hit, showing the pressure. For smaller companies like Rivian and Lucid, who are still burning through cash, still trying to scale up, this expected cooling in U.S. EV demand right after the credit ended, that's a serious headwind. They just don't have the profitable gas or hybrid cars like Ford or GM to fall back on.
Right, no cushion from other segments. And that expected softness in EV adoption, does that ripple outwards? What about, say, EV charging networks?
It absolutely affects them. It's pretty straightforward. If fewer new EVs are hitting the road in the near term, the growth in demand for charging slows down too. Slower adoption means, well, lower revenue potential, lower usage rates for the charging stations.
So companies like ChargePoint Holdings, that's CHPT, and Blink Charging Company, ticker BLNK.
Those are the main public players, yes. Analysts were already sort of anticipating this, that Q3 pull forward of sales would likely create what they call an air pocket in demand for Q4, maybe Q1.
An air pocket?
Yeah, just a temporary dip in utilization growth. It's not necessarily a disaster, but for companies whose valuations are often based on really high growth expectations, any slowdown, even temporary, in how much their chargers are being used, that hits their numbers and how investors view them pretty quickly.
Okay, got it. So pure-play EV makers, charging networks, was the third category of losers.
We need to look further upstream to the battery materials suppliers. The volatility eventually gets to them too.
How so?
Well, they face pressure on both volume and pricing, and it's tied pretty directly to North American EV sales numbers. If automakers think demand will be softer in Q4 or Q1, they might adjust their production plans downwards. And if they do that, the orders for the raw materials needed for batteries, those drop almost right away.
Okay, so which companies are we thinking about here? Those supplying lithium, things like that?
Yeah, exactly. Key materials. So Albemarle Corporation, ticker ALB, is a major one, heavily involved in lithium. And maybe a company like American Lithium Corp, ALTM.
And the rationale.
It's basic supply and demand, really, but amplified by how contracts often work. An expected dip in new EV sales means less demand for batteries, which means less demand for lithium and other key materials. This gives automakers leverage. They can use that temporary demand slack to push for better prices on their material contracts. So the pressure lands squarely back on the suppliers like Albemarle. They might see lower volumes and face pressure on pricing.
Okay, so let's try to wrap this up for everyone listening. Tesla's Q3 numbers kind of expose this convergence of factors. You had serious cost pressures, those tariffs, the big AI spending hitting at the same time as this demand volatility caused by the tax credit ending.
Right. And that combination basically split the market, at least in the short term. The winners appear to be those with some insulation. Diversified automakers like Ford, F, and GM, key tech suppliers like NVIDIA, NVDA, and Supermicro, SMCI, and domestic material producers like U.S. Steel X and Alcoa, AA, who might benefit from that tariff friction.
And on the flip side, the losers, or those facing headwinds, are the ones most directly exposed. The pure-play EV companies like Rivian, Lithium, and Lucid, LCID, the charging networks like ChargePoint, CHPT, and Blink, BLNK, that depend on rapid growth, and the upstream battery material suppliers like Albemarle, ALB.
It paints a pretty clear picture, for now at least.
One final thought maybe, that consistent heavy spending on AI and robotics by companies like Tesla, it makes you wonder how that ongoing investment might keep influencing profit margins across the whole auto industry. Even separate from these temporary things like consumer credits ending. It's a big strategic cost, but it also signals where they see the future.
Definitely something to keep watching. And just a reminder for everyone, this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.